Welcome
Hi.
to Disrupt.
Great to be here. It's been a few years.
Yeah, I understand you were here 6 years ago. What's
Apparently.
changed? What's changed over this time?
Oh, not much. No, global pandemic. We recently IPO'd. Yeah, things have come a long way, I'd say.
Yeah.
But things are on a good track now, for sure.
So let's start. The topic of this conversation is how to build a company that lasts. When you founded Chime in 2012, you were entering a space dominated by incumbents who made money by lending to and holding deposits for wealthier individuals. But for people who were living paycheck to paycheck, they were charging monthly fees and overdraft protection penalties. You set out to change that by making it less costly for everyday Americans to use banking. Yet you were facing challenges when you were trying to raise from investors. They didn't understand your business model. Why?
Well, I think the problem that we set out to solve, which was to do a better job of serving everyday Americans, people that make up to about $100,000 a year, with their basic banking, financial, and payment services. And when you go and you pitch a high net worth venture capitalist and you say to them that banking is broken for people that make $40,000 or $50,000 a year, we found that messaging didn't often resonate with people who generally had private bankers. I think they were far more likely to have a pitch around hitting a button in your app and having a black car go to your house instantly or within 5 minutes. That resonated with the venture capital class better than fixing banking for everyday people. So look, we got a lot of no's in the early days, and that's why I love to come and talk in a forum like this that hopefully inspires entrepreneurs that even if you get a bunch of no's in the early days, that if you feel in your heart that you have a concept that actually can work, and then you prove that you can execute against a plan, that anything is possible. So, it took a little while to get investors. We were not the belle of the ball by any means from the earliest days, but I think over time we established great credibility, and look at us now.
Yeah. So there was a point where you were rejected by over 100 VCs. That was...
for sure.
Yes.
Yeah.
Then you were trying to raise your Series A extension, from what I understand, and you almost ran out of runway. Take us back to that time. What did you do? There was a single investor who actually ended up investing, and she saved you. But take us back in the time. What did you learn from that period, and how did it set you going forward?
Well, I think my co-founder Ryan and I have always set a tone of mostly being focused on our members. We talk about being member obsessed and doing everything we can to make sure that we're delivering for them. But I think just the way that we operate day to day is one that is very optimistic. So, you mentioned that time when we were running low on cash. That was not the first time we almost ran out of cash, trust me. But that particular moment was a tough one for us because we were doing this extension round, sort of like raising additional capital on the same terms that we had raised a prior round. And there are a lot of investors that wouldn't even meet with us. We don't do extension rounds. Companies that have to do an extension round are toxic and they never work out. So, we ended up finding a great match with, you guys reported on the story about Lauren Kolodny at Aspect, now Acrew. And she sort of gave us a lifeline, and she's always believed in us. And, that optimism seemed to work for us at every chapter, even in those early days where, the term sheets only came in one or two at a time. Fortunately, by the time we got to our Series C round, we had quite a few term sheets.
So what was that inflection point? Like, what started working in the business, and how did you show to investors that this is good, and there was excitement about the company?
Well, I think there was a lot of skepticism in the early days that you could make a business model work in this category that was largely payments driven. They assumed that it had to be a very heavy lending business in order to make unit economics work out. And we do some credit and lending for sure, but primarily we are a payments driven business model. And I think we had to do two things. One, show that we could actually have breakout scale and show that we could actually grow exponentially. And then I also think between our B and our Series C round, we were able to prove that the unit economics were actually coming into place. And I remember, I've told this story once before, but when you go out and you pitch investors, you generally give rosy, optimistic projections, but ideally you need to make them attainable, achievable. And I remember we put a bunch of projections that were pretty aggressive in our Series B pitches that we went out and gave everyone. And by the time we went to raise our Series C, we had blown through those numbers, both on the top line, user growth, and importantly, unit economics. And no longer did investors have to squint to say, like, man, could this business actually work? They could see it. And so for our Series C, we had 10 or 12 term sheets and could kind of pick who we wanted to work with. And
What year was that?
that was 2019, maybe 18?
No.
Yeah, I
Like
think
19,
early 19,
yeah.
early 19.
And that was a $6 billion valuation.
No, the Series C was about a $500 million
Yeah.
valuation.
Yeah. Well,
Yeah.
more or less, depending how you post money, pre-money. But
Yeah.
that was a time when people started really paying attention to unit economics. That was when like Uber and Airbnb and everybody really talked about that being an important metric. So that was a huge inflection point.
You got to be able to show people that the unit economics are actually going to work. At some point, it's like everyone can have dreams and everyone can have visions of creating a business, but you have to be able to show, at some reasonable point that, this is a business that can scale and actually generate cash flow.
Yeah. And it took you how many years to get a positive unit economics?
It took us quite a few years. I think, we really didn't show that a real compelling payback on acquisitions until probably Series B, Series C. So that was 6-7 years into the model. It definitely took us a little while, but I think this category of payments is one that really rewards scale, and at that point we were starting to reach sort of the breakout territory of scale. Now we're almost in the top 5 in terms of transaction volume on debit cards in America. So we've clearly had huge breakout scale, and with a business model that, even though it's in the category of banking and payments, our margin profile is more similar to a software or a SaaS company. Because we're not actually a bank. We partner with banks that hold deposits on behalf of our members in FDIC-insured accounts. So someone who signs up for a Chime account, think of it as essentially signing up for a tri-party arrangement between the consumer, Chime, and the bank. The money resides at the bank, so you get the same protections that you'd have at Chase or Wells Fargo in terms of FDIC insurance up to $250,000 and provisional credits on disputes and all those sort of legal protections that you have. But Chime plays this role of designing these really intuitive, easy-to-use member experiences with products and services that address the most important needs of this everyday consumer that makes up to about $100,000 a year, which is about 3/4 of our country.
Yeah, that's a big TAM. So 2019, things were going well for you. Then 2020 happens. We have COVID. What happened?
Well, COVID was terrible for society, but it actually was a great moment for us to sort of demonstrate our member focus. We actually saw huge growth during that period. I think one of the secrets of our success has been our ability to develop and cultivate these primary account relationships. So people that sign up for a Chime account and then get recurring direct deposit into their account. So during that time of stress, when people started to lose their jobs, and we found that we actually outperformed, because a lot of the consumers, if they kept their job, they continued to get direct deposit into a Chime account. If they were getting an unemployment benefit, you send that to your primary account, which is their Chime account. If you got a STIMI payment, you got it to a Chime account. So I was really proud of how the team executed during that period of time. In fact, we were the first company to offer early access to your stimulus payment, which ended up, that just happened sort of organically inside of the company. But it ended up being a great marketing moment for the company, even though it wasn't the intention. We got all this coverage in the New York Times about, hey, there's this company that gives you access to your stimulus payment early and gives you free overdraft and all these sorts of things that we've become really well known for. So that was a big moment in time for the company. We went through tremendous growth during that period. I also think during times of struggle and stress in generally, people look for great value, and that's something also that we stand for because we don't charge monthly fees or minimum balance fees. We don't have ticky-tack fees for overdrafts and these sorts of things that the banks rely on so heavily for this target segment we serve.
So you consider yourself counter-cyclical to a certain extent?
Well, a really negative economy I don't think is really good for anyone, but I would describe us more as resilient, even in challenging economic environments. Because if you look at the spend that happens on Chime, from Chime accounts on Chime cards, around 70% is on non-discretionary payments. So meaning like your rent, your groceries, your sort of everyday transactions that are going to happen no matter what. So yeah, even in challenging times, it's a very resilient model. It's an awesome business in great times, and it's still a really, really good business in more challenging economic times too.
Okay.
Because even the lending we do, it's very, very short-term in nature. So we give people access to their paycheck on demand for free at any point in time over the course of their over the pay period, rather than having to wait the 2 weeks to get paid. People can get access to their paycheck up to $500 for free in our app, and so people really appreciate that.
So take me back to 2021. That was kind of the height of the fintech hype, and your valuation ballooned to $25 billion. A lot of your peers went public then. There were reports that you were planning to go public in 2022, but then interest rates began to rise. Russia invaded Ukraine. IPO window closed. You didn't go public. Was that a blessing or a curse?
Oh, it was a blessing for sure. We had raised a big round of financing in 2021, and we hadn't said it publicly, but we were certainly starting to think about our plans to become a public company, and we started to put all the motions in place that you need to do in order to mature internally to be ready to become a public company. So all the things around audit and SOX compliance and bringing more people onto the team that had experience into this area. But look, I think in retrospect, if we had gone public in 22, it just would have been too early. We weren't a mature enough company, I would say, internally to have been able to do that. So I actually think it was a blessing. We had raised a large round of financing, so we had more than enough capital to survive. And I think we were able to weather the storm that was pretty difficult from a capital markets perspective, but we'd already raised the money. And like I said, our business actually performed exceedingly well during COVID and now beyond. So we did go public this year, and I just think about all the work that went into that, and there's no question in my mind it would have been a little premature if we had done it in 2022.
How did you maintain employee morale during that correction period? Because you also had some layoffs, and you did finally go public in June, so congratulations. But there was a long period of, we don't know what's going to happen. How did you make it through that time?
Well, we're very fortunate, I would argue, because we truly are a mission-driven company. We help everyday people who have been fleeced historically by the incumbents. And so that's a message and a mission that really resonates with a lot of employees. And I would bet if you ask the majority of people why they work at Chime, that's a big part of their consideration set, is that they actually feel like they're doing work, or maybe they grew up in a family that was facing financial struggles early on. So the mission that we're solving for here to help everyday people make financial progress really resonates. So look, I think that a little bit of that reset that happened during that time was really good. I think that Silicon Valley overall became a little bit overly entitled in a lot of ways, and I think it was a great opportunity for us to reset the team and focus on what really matters, which is serving our members more so than what flavor frappuccino we have at the counter in the cafeteria.
Yeah. So you went public this June. Why was that the right time?
Well, we were proud of being a real leader in terms of, at least our investment banker friends tell us that we helped to open up the IPO window again back when we went public on June 12th. The timing was right for us for a number of reasons. First and foremost, we are building a generational company here. We are now, if you look at, like J.D. Power just did some research that they released in the last couple weeks that showed that for people who have switched their checking account relationship in America, Chime's the #1 destination for where people are switching their bank accounts. Just last month, Time Magazine put out a survey. They surveyed tens of thousands of Americans, and they asked, what is the number one brand in online banking? Chime's the #1 brand, according to this research survey, higher than Chase and Wells and all these sorts of things. So we're building a generational company here, and of course it's natural for a generational company to be a publicly listed company. We didn't necessarily need the capital, but we were able to add close to $500 million to our balance sheet, and we now have a publicly traded security. We'd like the stock price to be higher, but we now have a publicly traded security that gives us a lot more flexibility in terms of capital markets, financing, M&A. There's a currency here that allows us to be able to, I think, have more flexibility. And look, we've been at it for 13 years, and we thought it was a great opportunity to give employees and early investors access to the public markets and more liquidity.
What's the biggest surprise about being a public company?
Honestly, the biggest surprise is that, the party was pretty awesome, not gonna lie, but the next day, nothing really changed. We had already been operating with a tremendous amount of discipline, managing the business quarter to quarter, making sure that we're closing the books on time and checking the boxes in terms of making sure that we're running a tight ship and staying close to forecasts. And so yeah, probably the biggest thing is not that much has changed, to be honest with you. If anything, I've just really appreciated it because there was such a long lead up to going public that really took a lot of my time away from the day-to-day operations of the business. So it's been really fun to be able to roll up my sleeves a little bit more than I was able to in the sort of 6 to 12 months leading up to the IPO.
Yeah. Many of your peers are staying private. For instance, Revolut in Europe, they're reportedly raising a large round of financing, which means IPO isn't imminent. So why are others not taking this route? Why do you think that? And do you regret going public when you did?
Well, there's no question that the cadence of being a public company does add pressure and does add stress and adds operational rigor that you don't necessarily need to have quite as tight as a company that intends to stay private. When I was actually just reflecting with our CFO about this recently, I actually think the lead up to operating like a public company and now being a public company, I just think it's great hygiene. It allows the company and reinforces across all levels of the organization that we have accountability. We have accountability towards goals that we say that we're going to achieve, and we have tight timelines to prove our success and our progress towards that. As a private company, those check-ins may be more like every 9 months, 12 months, or beyond. But as a public company, I actually think it's a really healthy thing for an organization to have that sort of accountability and to be able to prove that you execute and that you do what you say you're going to do. And that's what we intend to continue to do here as a public company.
Yeah. So I think this is an important question for probably lots of people in the audience. You're an expert in surviving a major hype cycle. Given the current AI bubble talk, what advice can you offer to AI founders?
Well, I think the most important thing to do is the team around you is more important than anything. No one's a one-man or one-person show, so making sure you have the right team around you and using whatever capital you raise to make sure that you fortify that leadership team around you is more important than anything, because you may have a vision, you may be able to espouse how you want the culture to be and so forth, but if you don't have your lieutenants living and breathing that same doctrine, it all falls apart. So build a great team. And I also think just building the right investor base that believes in you as a leader, believes in the mission of the company. I remember in 2019, we had an operational challenge from a third-party processing system that sort of had a bit of a hiccup. And we had we actually had a term sheet in hand. And I remember me and my co-founder were nervous that the investors were going to pull the term sheet, but they knew that it was a small blip and that we had responded well, and we showed that our members loved us and that we had a good plan to serve them for many, many years. And so they stuck with us. And I just think making sure you have great sort of high integrity people that truly believe in the vision and aren't just caught up in the hype cycle, because if you take money from the wrong set of folks, I think it could end up coming back to bite you. Fortunately, I haven't had that issue.
Yeah. And so in retrospect, you don't regret taking money at higher valuations, because I think this is what's happening now in AI. Like, valuations are higher and higher and higher, and this rounds are happening back to back. We had something very similar happen during COVID with fintech, and a lot of people are comparing what happened with fintech in 2021 to what's happening with AI now.
I think we're all adults. The operators are adults, the investors are adults, and markets move up and markets go down, and investors and companies play the game that is being played on the field at that moment in time. At that point in time, when we raised, the market was certainly white hot. At this moment in time, AI is obviously white hot. They're not all going to win. But that's the price that investors pay in order to have an opportunity to share in the upside of investing in generational companies. And we still have incredibly constructive, long-lasting relationships with all of our investors. And I imagine that there's going to be a lot of really, really happy investors in this AI bubble, or whatever you want to call it now, hype zone that we're clearly in. There's going to be some winners, and there's definitely going to be some losers. But you play the game that's on the field.
So it sounds the biggest advice is find the right investors.
Find great investors, yeah. Find great investors that truly believe in the company and have your back and give you the ability to execute on the milestones that you have articulated in your last financing. That's the key to everything, right? You put a bunch of milestones in your pitch deck, you either achieve them or you do not. If you keep missing them, you're probably not going to be able to get that next round of financing. But fortunately, we were able to do that in those early days, even though we weren't necessarily, the most sought after investment in the very, very early days.
Well, congratulations on the IPO, and fingers crossed the stock will do a little better. I know it's markets. Now you see what it changes every day. Whereas when you're a private company, it just only changed when you raised a round of financing.
We still have a long-term focus, and it's kind of like I said earlier. In those early days of pitching investors, maybe not everyone totally understood the size of the opportunity that we had and our success in executing against this segment. And we need to do the same thing in the public markets, which is continue to execute, do the things we say we're going to do, put points on the board, and continue to execute quarter after quarter. And if we do that, I think it's all going to work out.
Thank you, Chris.
Thanks a lot.